On December 10th, the Federal Reserve cut the Fed funds rate by 25 basis points, 0.25%. This brings the new target range to 3.50%, 3.75%. This small cut is a big signal. The Fed believes the economy is cooling down, but they're trying to prevent it from collapsing. Think of the Fed funds rate like the floor of your house. If the floor moves, every other room shifts. It's the rate banks charge each other for overnight loans, but it's the foundation for almost every other interest rate in the economy. When it drops, it eventually lowers interest on credit cards, car loans, personal loans, and even your savings account. The heart of this decision is the job market. Hiring has slowed, and unemployment has been creeping up. When unemployment rises, people stop spending, which can trigger a recession or even stagflation, a toxic mix of slow growth, high inflation, and high unemployment. The Fed is cutting rates now to protect the labor market before it falls apart. Behind the scenes, the Fed officially ended quantitative tightening. QT is when the Fed shrinks its balance sheet by letting bonds mature without replacing them, which pulls money out of the system. Now, they've started buying $40 billion in short-term treasury bills per month to keep cash flowing through banks. They won't call it quantitative easing, but it's the opposite of tightening. In a rare move, the vote was split 9-3. 2 members wanted no cut because inflation is still too high, while 1 member wanted an even bigger cut. This tells us that even the experts aren't sure where the economy is headed next. Plus, Jerome Powell is now a lame duck leader. His term ends in May 2026, and President Trump is already interviewing replacements who might be more aggressive with rate cuts. A 0.25% cut won't change your life overnight, but over time, you'll notice lower rates on credit cards and car loans. However, since the job market is cooling, you should be cautious. Consumers, avoid taking on massive new payments if your job is uncertain. Investors, expect more volatility in the stock market, especially in tech. Stay steady and keep dollar cost averaging into your investments. Real estate, mortgage rates may drift downward, but don't expect a return to the 2% pandemic lows. Headlines will be loud and the future is uncertain, but your personal success depends on staying disciplined. Don't let the headlines run your decisions. Let your strategy run your wallet.